Our next guest says stocks are clearly being driven now by bonds, and he expects Fed Chair Jay Powell to calm investors when he speaks this Friday at Jackson Hole. Let's bring in Ed Yardeni, president of Yardeni Research for months. Ed, and we ask a lot of people why the 10-year seemed to be disconnected to the Fed and Fed comments, and people said, well, it's technical. People are buying 10 years around the world. And so it finally did move. It moved 30 basis points or 40 basis points. Is it in an extended uptrend, the yield, or are we near the highs?
I think we're near normal. If you look at the 10-year bond yield prior to the great financial crisis back in 2008, right through the great virus crisis, during that period, interest rates were near record lows, close to zero. But now we're going back to a period prior to the great financial crisis in which the 10-year bond yield was something like 4.5% on average if you look at the years prior to 2007. So I think we're kind of returning back to a normal bond yield. And maybe that's why the stock market isn't all that upset about it. Normal isn't necessarily bad.
Is normal at what was it when yields were 7, 8, and 9% on the long end? And you remember that. And I don't remember that. I wasn't afraid, and the stock market wasn't afraid, and American business wasn't afraid. We did just fine in that interest rate environment. But I don't think we're ready for that now, and I think that would be a shock to the system. You do not think that above 6% on the 10-year is happening in the next 2 or 3 years? No?
No, I don't. I have my concerns, as everybody does, about profligate fiscal policy. Clearly, the deficit is widening again, and supply and demand in the past really never mattered that much to the bond market. It was always really inflation and what the Fed would do about it. But I think in recent weeks, we've seen that the bond market suddenly really cares about the supply issues. It might have had something to do with the Fitch ratings downgrade, just reminding us all that there really is a remarkably different profligate policy going on with regards to the outlook. And then the Congressional Budget Office has confirmed that if nothing has changed in the law, the deficit outlook is pretty grim. But I think the bond market still is driven to a large extent by inflation. And I believe that the inflation news to date has definitely shown a great deal of moderation since last summer. And I think it'll continue to show moderation going through the end of the year.
Well, we've heard that now there is an alternative to stocks. I don't consider 4.3% able to just suck the air out of the stock market. That seems like a pretty friendly number. And I imagine that it's not different this time, and we can expect stocks to outperform bonds over time.
I think that the fact that the bond yield is where it is today demonstrates as evidence that the economy is remarkably resilient, that earnings are going to be better than expected, not just this year, but next year as well. And the stock market is looking ahead to next year. And I think the market's going to hang in there. I think right now we're in a pullback that will maybe last through the end of September, the traditional seasonally weak period. But I think a year-end rally will bring the S&P 500 back to something like 4,600.
Well, I hope so. And so, I mean, I only hope so because I hope we get some growth in the economy that allows us to deal with some of this debt, because it's very concerning at this point.
Absolutely.
Long term, I don't know how we deal with it. You know, we got these people in Washington.
Well, growth and productivity are really the answer for solving that problem.
All they do is they do things that make it hard to do that from both sides of the party. So I don't know.
That's correct.
All right. Thanks, Ed.